Need computer training for a group or office? Contact us today to get a free demo of our training at www.teachucomp.com/enterprise-licensing.
Although you do not have to be fluent in accounting terminology to understand QuickBooks, it is necessary to have a basic understanding of some concepts prior to entering information into the program. The first concept you will need to understand is the chart of accounts. A chart of accounts is a listing of all of the accounts used within your company file. You can open your chart of accounts by selecting Lists from the menu bar and then choosing the Chart of Accounts command. Your chart of accounts shows the names of the different accounts used by your company, their account type such as income, bank, or one of the many other account types, as well as the current balance for the account. There is a column called Attach, which shows any attached documents associated with the account, and the document management service that provides the ability to add attachments to accounts is a service you must purchase separately from QuickBooks. Now next let's examine the different general account types found within the chart of accounts and how they are organized. The chart of accounts has a default sorting method. Assets are at the top, followed by liabilities, and then equity. These accounts are shown in the balance sheet report for your company. Now following those accounts within the chart of accounts window are the income accounts, followed by the cost of goods and expense accounts. These accounts appear within your profit and loss report for your company. Now at the very bottom of the chart of accounts window are accounts for non-posting transactions like purchase orders and estimates. So as mentioned before, at the top of the chart of accounts window, you'll see your balance sheet accounts which appear on the balance sheet for your company file. These accounts show what you own, your assets, what you owe to others, which are your liability, and the difference, which is your equity. Now below those counts you find your income and expense accounts, which track where money comes from and what it is spent on, respectively. Now each of the balance sheet accounts has a register associated with it. Unlike the balance sheet accounts, the income and expense accounts each have a report that lists the transactions associated with the account. Now we'll look at these different types of accounts in more detail in later chapters, but let's review the general list of the different types of accounts and whether they appear in the balance sheet or the profit and loss statement within QuickBooks. So first you have your assets. And assets are what you own and what other people owe to you. More specifically, the money that people owe to you is called your accounts receivable. Other assets may include checking account money, inventory, fixed assets like computers or furniture, and undeposited funds received from customers. Now also note that when you set up your company file in QuickBooks, although your checking, savings, and petty cash are all company assets, you'll set them up as bank-type accounts within QuickBooks to note their cash nature. The available types of accounts that are assets are bank, accounts receivable, fixed asset, other current asset, and other asset. Now the assets appear in the balance sheet. Next, we'll look at liabilities. Liabilities are what you owe to others. The unpaid bills that you have are specifically referred to as your accounts payable. A liability could be a loan, an unpaid bill, or taxes owed. Also note that when you set up your company file in QuickBooks, although credit cards are company liabilities, you'll want to set them up as credit card type accounts within QuickBooks for ease of use. The available types of accounts that are liabilities are credit card, accounts payable, other current liability, and long-term liability. Once again, liabilities appear within the balance sheet. Now the last type of balance sheet account is equity. And equity is the difference between what you have, your sum assets, and what you owe, the sum of your liabilities. The basic formula for calculating equity is assets less liabilities equals equity. Equity is seen as representing the health of your business, and equity can come from three different sources. investor money, current year profits, or retained earnings, which are profits from past years that haven't been distributed to shareholders. Note that the only available type of account for equity is the equity account type. Next, we'll look at the profit and loss statement accounts, or the income statement accounts as they're also called. First, you have income accounts. And income accounts are simply used to track the income that is generated by your company. Next, we have expense accounts, or cost of goods sold. Expense accounts are used to track where your company's money was spent. The expense accounts also appear in the profit and loss statement and can either be expense or cost of goods sold, which is the money that is spent to purchase inventory.
Like what you see? Get a free demo of our training for groups of 5 or more at www.teachucomp.com/enterprise-licensing.